Welcome back to All Things Real Estate. I'm Terry Lee Joe, your host, and I'm here today with Paul Godbout from New American Funding. You're a lender, and tell us a little bit about you and like what you do, because I want our folks at home to get a good idea.
Well, thanks, Terry. Should I start with personal things about me, or just talking about business?
You can.
Yeah. Well, I'm Paul Godbout. I live in Hooksett, New Hampshire, just up the street from us here. I have 3 little kids at home and a beautiful wife named Christina. And I've been in the lending business now 25 years.
Wow.
So a long time. And I just love helping people buy houses, refinance to save money, or buy that investment property to grow their net worth. So that's what I've been doing for a long time.
Fantastic. Mm-hmm. So what's your favorite part of what you do?
I think that is my favorite part of what I do, and going to the closings. So, I love going to my closings and seeing the fruits of our labor, right? And the smiles and the hugs at the end, and helping people achieve their dream of home ownership. So that's the best part of my job, that intrinsic value. It's great.
There's very frequently a lot of happy tears at the closing.
Right. Yeah.
And that's cool.
Yeah. Hopefully it's not sad tears.
No.
Though we do handle that too. So people that are getting divorced, or there's a death in the family and we need to refinance to take care of that. And so sometimes there are tears in those situations, but being a former florist, you get to see all aspects of life, right, from birth to death, and you see all those things. So it actually translates pretty well into the mortgage business.
Mm-hmm. Yeah. Mm. We like those happy closings. So.
Yeah, the happy ones are much better.
Yeah, they are.
Yeah, we've had a lot of those together, so it's good.
We do.
Yeah.
So today we're going to talk about kind of the basics of what you do in lending, and maybe an overview of kind of what some of the services are you offer, but I really want to dig into the pre-approval process. Mm-hmm. So give us that overview of like, what does lending look like with you? Because much like real estate agents, right? Every lender is different.
Right.
You guys do things differently, different companies and things like that. So give us an overview of the lending for you and your company, and we'll go from there.
Yeah. So in the pre-approval process, we're really taking a snapshot of the person's financial picture. So we're looking at their income, assets, employment. So basically the 3 C's. Have you heard of those before?
No.
No. All right. So we're looking at basically the 3 C's are collateral, credit, and capacity to repay.
Okay.
So when in the pre-approval process, we're not really sure what the collateral is going to be. We can assume what it might be. Somebody might say, I want to buy a mobile home, or I might want to buy a multifamily. So we can kind of assume, or a single family, we can assume what it's going to be, but we don't know exactly what the house is going to look like yet. So we're really the pre-approval is really on the person's credit. So we're going to take a look at credit, and we typically pull what's called a soft pull. Right. That way, our clients don't have a hard inquiry, which could actually drop their score in the future. And we can do about 90% of the work we need to do with that soft credit pull. So that's the first thing we do. So we're going to take their vital signs. It's like going to the doctor, right? So we'll take your vital signs, but we're taking your financial vital signs. Like I said, income, asset, employment. Take a look at the credit. And then based on the person's credit and their income, we'll be able to pre-approve them for, how much home they can afford, depending on how much money they're putting down.
And so there's a couple ways that you can decide what they're pre-approved for, right?
Mm-hmm, right.
So you can do it, what you just said, based on what they can afford.
Right.
Or you can also do it based on the payment that they want. Mm-hmm. Because not everybody wants to max out what they can afford. Right. Some people want to say, I'm going to be a little more conservative, and based on this payment amount, what can I go buy?
Right. And it's a lot like buying a car, right? Because you're really just buying the payment.
Correct.
And that's a lot of the mortgage business too nowadays, because nobody's going to go out there and drop 500. Well, some people do, but a lot of people don't. Most people don't have $500,000. What's the average sale price in Southern New Hampshire right now? 550,000, yes. 580. So not too many people have 550 or 580,000 to go drop on a house just to buy cash, right? And so they're financing the payment. So yeah, and there's a thing called payment shock too. I don't know if you've heard of payment shock.
Yes.
So if somebody's paying, $1,000 a month right now, and suddenly want to go buy a house that's $4,000 a month, that's 3 times, 4 times more what they're paying now. So we would consider that payment shock.
Yes.
And so it sounds sometimes it looks good on paper, but in reality, can the people afford it, and do they really want to make that payment? And so they might say, okay, I can afford $4,000, but I want my payment to be $2,500 a month. And so that's a different conversation.
Well, because life is part of this equation, right?
Yeah.
People have hobbies, they have different things that they like to do, and they don't want to give that up.
Yeah, and we don't want to make people house poor.
Correct.
So we don't want to have them in there and they're eating ramen noodles the rest of their lives.
Yeah, that's no fun.
It's no fun. They can't go on vacation, can't go to the restaurant. That's not a way to live.
Well, and what ends up happening is people are going to do that anyway, and then other things suffer. And so we work really hard to make sure that, we don't put people in a bad
Yeah, we don't want to put
spot.
people in a bad spot.
No, that's not cool.
Now, guidelines allow us to go pretty high on their people's pre-approval. On some loan programs, we go up to a 57% debt to income ratio.
Now explain
Or
that.
higher. So I'm going to explain that. So let's say you make $10,000 a month. That means we could have pre-approved the person for a back ratio, meaning all of their monthly debt, their mortgage payment, taxes, and insurance, up to $5,700 a month. But if you actually work that backwards, if they make $10,000 a month and they pay Uncle Sam taxes, they probably get $7,000.
Right.
Now they have to pay for heat, electric, cell phone,
Car.
car we know on the credit report probably, but childcare, we don't factor those in.
Okay.
So, and then you have to buy food, and you need cable, and you need TV, right? So at the end of the day, that means you have $0. If you do that, you basically have $0 left over to qualify to pay for anything else. So that would be a definition of being house poor.
Right.
Now, the reason why we can go that high in a lot of cases is that sometimes there's a spouse that may not be on the mortgage for whatever reason. Their credit's not great, or they just started a new job, or just switched careers, and they have income coming in, but we can't use it for qualification.
Okay.
And so we can make that lending decision because we know there's what's called a compensating factor there.
Interesting.
Yeah.
Yeah, without that compensating factor, that would be a scary
Yes.
position to put somebody in.
Right. And you don't want to put people in that spot.
No,
So
it doesn't end well.
doesn't end well. Right.
We don't like that.
We don't like that. Or if they know, like if they qualify and their debt to income ratio is high now, but they know in 2 months they're getting a raise and they're going to be getting $10 more an hour, well, then, they can make we can make that informed decision.
Right. Even still, though, keeping money aside and being on the conservative side, that's one of the things I like about working with you is you keep things more on the conservative side. And I don't know of anybody that we've sold a house to that that's gone into foreclosure later and hasn't been able to make the payments.
Right.
And I like that. I want to put people in houses that they can live in and stay in until they're ready to move.
Right.
And you have that same philosophy.
Right. Well, because you and I are looking for clients for life.
Correct.
So we're looking at this from we're looking at the whole picture, not just can we put this person in a house. We're looking at, can they afford it? Are they going to be happy? Are they going to come back to us? Are we going to do a good job? And they're going to be so happy they're going to refer us to their friends and family. And that's what we're looking to build. And then when they're ready to buy their next house or move up, we want to do such a good job that they're going to come back to us.
Sure.
So that's really the goal, right? And we want happy customers who are going to use us again.
Which is fun.
Yeah, which is fun. And then you
having them come back.
then you help them again, and then you help maybe their kids when they're old enough, and so on and so forth. I haven't helped anybody's grandkids yet, but
I've got one.
you have one already.
I've got one.
Okay, well that's good. See,
21 years.
Yeah.
I've done the parents, the children, and just did a grandchild.
wow, that's amazing.
Yep, that's fun.
Yeah, maybe
And I have one client that I've done. We've had 12. A regular client, a regular buyer seller who's going to live in the home, not my investors, but I've had one of them that literally has bought 12 houses from me, bought and sold.
Right.
So it's fun.
Yeah. And just going back to that, so we do want to put people in the right program and put them in the best position. So sometimes the answer, when we're looking at it from that perspective, is sometimes the answer is no, or not right now,
Right.
because we either have to work on credit, or they don't have quite the income yet, or they need to save more money for the down payment. So we'll advise those people on what to do, and then maybe revisit it in 6 months or a year, and have people get on a plan or a track so that they can succeed financially on the real estate side.
And I like the not right now.
Right. I don't usually say no.
There-
If you do X, Y, and Z,
We can get to yes.
Yeah, we can get to a yes. Absolutely.
Absolutely.
Yeah.
So going back to the pre-approval process. So what does it look like for the consumer to go through that pre-approval process? Like, what is there a lot of paperwork for them to fill out? Like, what are the documents that you're going to be asking for? What does it look like from their perspective, so
Right.
they know what to expect from you?
Yeah. So in lending, we're in the prove it business. So I like to say that. So basically, we're going to do an online. Most clients nowadays, they're more comfortable and they just like doing the online application, because the online application maybe takes 15 minutes per person. So maybe 30 minutes total. It shouldn't take that long. I mean, if you actually focus and just do it, it's probably 10 minutes each, tops.
Okay.
So that's typically the first step, is to apply online. So I just have people go to my site, paulgodbout.com. They apply online. that'll come in, and then my loan officer assistant my loan officer assistant's name is Jay Frechette. He's been doing it for 21 years, and I have 25 years, so a long time.
Nice.
So, so that's the first step. Apply online. We take a soft look at the credit, like I said, and then we'll ask for supporting docs. So if you want to, we'll call the client and just review their application with them, make sure we have everything right. Because not 9 times out of 10, but quite often the client will apply, and sometimes people will put in, hey, I make $5,000 a month, but they're putting in their net income.
Right.
Where W-2, they actually make, let's say $84,000 a year, they're making $7,000 a month, but they put 5 because that's their after-tax income.
Right.
Or if it's a self-employed person, they'll say, I make hundreds of thousands a year, right? So we'll say, we'll call them and say, well, what's your net? Because on self-employed, we go off net versus gross. So
which is a big difference.
It's a huge difference. It's a huge difference. So if you're W-2, we go off your gross. If you're self-employed, we go off your net. So in self-employed people, by and large, don't want to show every dollar to Uncle Sam, right? So, and I don't blame them. So the government spends our money wildly and not very well, right? So it's not a political conversation, but I don't want to turn it into one, but we could. So anyhow, so we're going to look at their income. So we're going to go over the application with the client. Probably takes 10, 15 minutes. Find out what their goals are, what they're looking to buy, why they're looking to buy that. Try to find the reasons behind it, and then from that we'll ask for supporting documents. So typically a pay stub, most recent bank statement to prove the money's for a down payment. Okay. And we'll find out if they're working with a financial advisor, if they've talked to their advisor yet. If not, we'll usually get them in touch with one of our financial advisors to let them know what's going on. And
so if somebody, I run into this a lot, somebody has just moved to the area, so they have a new job,
right?
Or they just changed jobs. How does that impact you? And does it matter if they're in the same field doing the same job or if they've taken a completely different job?
Right. Good question. Good question. So it depends. But for the most part, if you stay in the same line of work, it's okay if you switch jobs. Okay. Now, if you're in the same line of work, but you switch jobs, but your line of work is commissions, let's say, or bonuses, that can pose a problem because we're not sure, we might not be able to guarantee that the commissions and bonuses you are making at this company are going to be the same that you're going to make in the next company. Right. So that could be an issue, right? And so we're going to look at that. But if somebody's a salaried position, hourly position, it's the same line of work. You know, let's say they do tree removal for a living and they work for one company and then they go to work for another company. That's fine. I mean, it's the same type of work. We'll be able to use that income. Okay. Now, the Fannie Mae and Freddie Mac loosen their guidelines on this also. Oh. So you can actually, if somebody's not even from this, let's say don't even have a job yet, but they're moving from out of state into New Hampshire, which is happening more and more these days. Everybody wants to live here because it's the best place to live. So let's say
the snow that we have today.
Oh, well, maybe not because of snow, but they think it's pretty until they have to shovel it. But so right. So it always seems like a great idea until you have to shovel your car out and scrape the windshield every day and everything else. Exactly. It's a little more work. That's why we're so hardy, Terry. Where was I going with that? Now I get sidetracked. But anyway, so let's say somebody's moving into the area and all they have is an offer letter of employment. We can just use it. Typically, we can use the offer letter of employment as long as it's the same line of work, and they can close before they even start the new job.
Really?
Just based on the offer letter.
Oh, wow. Okay.
It's pretty neat. We don't even need a pay stub.
That's crazy.
As long as they're starting, I think it's within 30 days of the, as long as they close within 30 days of the job starting.
Okay. So now what happens if they're in a completely different field?
Well, that can be tougher. So, for example, like FHA loans, if it's a completely different field, but it's still the same kind of type of work. Let's say somebody's a laborer and they're doing retail as a laborer, and now they go work at a manufacturing company. They're still doing laboring, let's say, but it's a totally different type of business, right? Right. They're working at Velcro, let's say, on the assembly line. A lot of times we can make that case because as long as they're making more money, for example, an FHA loan, they'll look at that as a positive because they're making the move to make more money. Right. Whereas maybe a Fannie Mae or Freddie Mac loan, they may not like that because it's a totally different industry. So we have to just place them in a different program depending on what they're doing. But we don't normally like it though. Like, so if somebody's switching careers totally, like let's say somebody's a realtor and they're very successful and loving that, but then they don't want to do real estate anymore. And now they want to go sell cars. I don't know. That might be a tough one, because now it's a totally different product. They're not selling house anymore. They don't have a 2-year history. We usually want to see a 2-year history on that type of a switch.
2-year history being tax returns.
Yeah. Well, if it's self-employed tax returns, or if it's W-2, 2-year, couple W-2s. Okay. Yeah.
Awesome.
Yeah.
So what happens when somebody has a regular job,
Yeah.
W-2,
Yeah.
and they get partway through the process and they're like, oh, I'm going to go start a business.
That's really tough. So it's really tough to go from W-2 to self-employed.
Right.
Because we have no idea if you know how to run a business. If you've run a business before, you don't have any history of running that business. So just don't do that.
Don't do that.
Just don't do that. Keep your job, buy the house. And if a few months later, after you buy the house, you decide you want to go become self-employed, you can. But,
Because basically once you've closed the house and you own it,
we're not going back to check on you.
Nobody's checking on it.
Maybe a week or two after to make sure you still have your job, but a couple of months in, people's plans. I mean, if your plan is to stay at your current job while you're doing the loan application, and you're going to work there, right? It's your intent. If that was your intention when we did the application and we lent you the money based on that intention, that's fine.
And intention being a critical word there.
Intention, yes. Now, if people change their mind all the time.
Right.
I've been married for a long time, so I know these things happen, right? so people change their mind and plans change, and that's.
Christina would never change her mind.
No, yeah, she probably wouldn't. She's pretty steadfast, but anyway, if your plans change after, your plans change after. Right. So yeah, why don't you keep making your mortgage payment on time?
You guys are happy.
Yeah, we're happy. Yeah, that's right.
So now there's one thing that shows up entirely too often. Mm. And as we go through the pre-approval process, and then we found a home and we're in that lending process, I'm always telling people, no big purchases, don't change your spending, don't change anything about the financial situation. And I've had several people that misunderstood that, and they went out and they bought new furniture for their new home on the no payments, no interest for 90 days or whatever that is. How does that impact what you do?
That's good advice. And always check with your loan officer is what I say. So don't make any big purchases. If you're going to, give me a call. Now, some people have such a perfect situation that even if they add debt, it's not going to make a difference, right?
Right.
So they have a low debt to income ratio. They make good money. They have great credit. It's probably not going to matter. Still a good idea to check with your lender, okay? Because we will do what's called, we'll pull a credit refresh before the closing.
Right.
So if that person's debt to income ratio was very tight, and they went out and bought furniture, they went to Jordan's because it's 0% interest, sounds great, or Bernie and Phil's, right? Because it's no tax weekend in Massachusetts or whatever it might be, right?
Right.
You ever heard of that? Yeah.
I have.
Yeah. Anyway, this is not a plug for Jordan's or for Bernie and Phil's, by the way. There's lots of good furniture companies out there. There are. Anyhow, but if their debt to income ratio is tight, but even at 0%, but now that payment's $200 a month, that could disqualify them from the loan. So because when we pull the credit refresh, here's the scary thing, right? So we could clear somebody's loan to close. At the end, the last thing we do is we do the final verification employment. So don't quit your job.
Don't quit your job.
And then we do credit refresh to make sure you didn't add any more debt. Now, if that added debt shows up, and then now you could actually disqualify yourself from the mortgage and put your earnest money deposit at risk.
Wow.
So don't do that, because what's the average earnest money deposit these days? It
varies. It's usually 1 to 2 to possibly 5% of the purchase price.
Right. So if the average house is $550 and it's 5%,
$20,000.
Now you get $20,000 on the line because you wanted to buy that. I know the couch was nice and had the dual power reclining, sofa, but just don't do it after you buy the house.
Because after you buy the house,
close the house, and if you want the next day to go buy the furniture, fine.
Right.
Yeah. Or buy it cash if you have enough money, and then.
As long as you're not taking the cash that you need for your closing.
Yeah, exactly. That'd be a bad idea. Yeah. Make sure. And make sure you always have. I always say have a couple thousand extra just in case, because tax prorations, fuel prorations, natural gas prorations, whatever it is.
Well, the other thing about going out and buying things before, and I've had people that have done it literally the week before closing, and it disqualified them, and there were some things that needed to happen, and they were able to go and get a gift letter and things like that. So they had a family member that was willing to help them.
Right.
And so we were able to do that. But that puts a lot of stress.
Yeah, it's just a lot of stress, a lot of headaches that the client doesn't want for sure, the lender doesn't want.
Right.
It just makes everybody's job more difficult. Then we have to let the realtors know, oh, by the way, Mrs. Smith went out and bought a new F-150, and so she doesn't qualify for the house anymore. So we don't want to have that conversation.
No, that doesn't go over well for anybody.
No. So just don't. You're right. Your advice is spot on. Don't do anything until after you buy the house.
And the other thing that I like to tell people, and I know you do too, is to have reserves, right? Like you mentioned, having at least a few $1,000s left over for reserves. One of the things I tell people all the time, especially my first-time home buyers, is Murphy is going to pay you a visit.
Yes.
It's not if Murphy's coming, it's when and how big.
Right.
And so when I bought my first house, Murphy came in the form of a new heating system. 3 months after I bought the house, I needed a new heating system. You don't plan on that.
No.
I mean, you may if you know that the heating system is bad and you've done your inspections and you know that expense is coming. But Murphy shows up on something you don't know.
Right.
So you could be planning to put a heating system in and have the roof leak. Or you could plan on the heating system and your car breaks down.
Right.
It could be anything, but Murphy will almost always show up.
Murphy does show up.
He does show up.
Yeah.
And he likes to wreak havoc.
Yeah.
On the best laid plans.
Right, exactly. And if you attend Murphys too often, then the other Murphy would probably show up more often.
I don't know about that, but that's okay.
You know what I'm talking about, like Murphy Stafford?
I do.
If you drink too much, you just have more problems, what I'm trying to say.
Well, there's that.
Yeah. So don't drink too much. It's
Don't drink
more
too
advice today.
So what other advice would you give to, let's look at like a first-time buyer. Because people who've bought before, they kind of have an idea of what this process looks like. First-time buyers, what do they need to plan for? Like, what can they be doing before they contact me, before they contact you? What are some things they can do maybe in the year to 2 years even prior to going out and trying to buy a house?
Well, credit matters. So the first thing I would say is make sure you pay all your bills on time.
Yes.
If you have I see this all the time. If you're not happy with T-Mobile when they say you want to get out of your contract early and they say that it's going to be an early termination fee, just pay it because, okay, or just keep T-Mobile until your termination fee is over because.
Or any phone company
or any phone company for that matter. They will always put the collection on your account. They always will. They don't miss. They're not going to forget it. I don't care if it's $200 or $2,000. They're not going to forget it. And I've seen so many people's credit get ruined by the T-Mobiles of the world, you know. Secondly, store credit cards. Store credit cards are notorious for that also. So if you're like 30 days late at all, it's on there. And they're not going to ever take that late payment off until it just expires. It's a battle. They do not play well in the sandbox. They're not nice to deal with. So don't apply for store credit cards. Make sure you pay all of your debts. Don't let collections go. Right. Because depending on the loan program, you have to pay it off anyway. So you might as well just pay it up front. So work on your credit. Keep all your credit card balances at 40% or lower of the high limit balance. That'll keep your credit scores high. Okay. That's it. Really, the credit's a huge piece because that's really going to determine how much money you have to put down, what program you're going to qualify for, what your rate's going to be. So your rate can swing wildly based on your credit score.
Rate's a big deal.
I mean, if you have perfect credit and some money down, we'll just use it for an example. I don't know what the rates are today, but let's just say it was 6.25 because of that. You might be paying 7.25 more if your credit's not good. You might be paying a full % more on that same loan. And if we do the amortization schedule, that could mean hundreds of thousands of dollars it's costing you because you didn't want to pay the $200 cell phone bill. So pay your bills. That's the first thing I would say. Secondly, save money. As much as you can save. Don't spend wildly. Keep your bills low. Be frugal. Put as much money away as you can. The more money you have down, again, the better position you're going to be in. The more flexibility you have on loan program you're going to get. Right. So you might find you don't want to be pigeonholed in an FHA, especially if you find a house that needs a little bit of work, right? You've seen this before?
I have.
So maybe if you save a little bit of money now, you can do a 5% down conventional loan instead of a 3.5% down FHA loan. Right. And now you can get that house where you may not have qualified for because it had some peeling paint or didn't have a railing on a stairway. And sellers,
a simple thing.
Yeah, a simple thing. And sellers these days aren't that willing to negotiate in Southern New Hampshire because it's such a hot market. Correct. So it's hard to beat somebody up to have them fix their house up. Right. They'll just sell to somebody else.
They will.
So
I'm going to jump back into paying your bills on time.
Okay.
Because I've seen this come up. What if somebody has an old collection account? Like it's been on there for 5 years. Right. Should they, right before they go get a mortgage, should they pay that off? No, don't pay it off. So, okay, so on the other hand, so good question. So, yeah, if you pay off an old collection, it becomes current when you pay it off. So it shows up on your credit as if you just had the collection, and so it actually drops your score. Now, over time, eventually it'll help you out. But in the short run,
it'll hurt you. So typically, if your collection accounts are under $2,000 and we're doing like an FHA loan, you don't have to pay them off at closing.
Okay.
If it's over $2,000, you got to pay everything off.
Oh.
So if all your total collections are $2,100, you got to pay them all off. They're $19.99. You don't have to pay them off.
Good to know.
Yeah. So
fair to say, if somebody if they pull their report through Credit Karma or, My Free Credit Report or whatever, and they see some old collections on there maybe they didn't even know about, should they talk to their lender if they're thinking about buying a house, talk to the lender before and say, you tell me what I should do?
Right. Yes.
Because you're going to know what's going to qualify them, what's going to disqualify them, and maybe they have to pay off one, but not another one. You're going to be able to guide them through that.
Yeah. Have their lender at least take a soft look at their credit. They can advise, the lender should be able to advise as to what to do, what to pay off and what not to pay off. And maybe it's not even affecting the score anymore.
Right.
So if it's, let sleeping dogs lie when it comes to that.
Right. Let's not wake that one up.
Don't wake that one up. Now, if you have a ton of collections, we're going to have to address it.
Correct. I think people that have a ton of collections kind of know that, though.
Right.
But
sometimes they don't. They just hope and pray it doesn't show up. Normally, when I hear the terms, I think my credit's pretty good. That's when you got to be worried.
It's all good.
Yeah, that's true.
All good. But ideally, pay your bills on time.
Yeah.
Sometimes things sneak in, right?
Yeah.
Things get misreported and things like that. But having you look at it first is going to give people a really good idea of where they stand.
Well, a little tip here is because online banking is so good now, just set up your online banking and set up everything up on auto pay. Just set up all your minimums on auto pay. You never have to worry about it. All your bills will be paid. And if you have a good month or you're making some money, grandma gives you some money, you get married and they throw you $20,000, great, pay off some more debt.
There you go.
But just set up everything on auto pay and don't worry about it.
Perfect.
Your life will be a lot less stressful too.
It will. Well, Paul, thank you so much for this wealth of information today.
Well, thank you, Terry, for having me.
What's the best way for someone to reach you?
Easiest way is either just go to my site, paulgodbout.com. That has all my information right there.
Awesome.
My phone number, everything. Feel free to give me a call, drop me a text.
Sounds great.
Or an email, yeah.
Thanks, everybody. We'll see you next week.